Warren Buffett is the last name people trust when they want to feel safe about money. Now read the uncomfortable part out loud in your head. He is not warning you about markets anymore. He is positioning for the endgame. Most people think Wall Street is a fair battlefield where skill gets rewarded. But when a man like Buffett changes from buying risk to hoarding cash the way a survivalist hoards water, you are supposed to ask one question, and you are supposed to ask it fast. What exactly is he afraid of, and who is supposed to pay for it? This is not financial advice. This is financial education, because in 2026, the education you were given is outdated by design. You were taught to invest like it is a meritocracy. You were taught that inflation is temporary. You were taught that if you just work hard and follow the rules, the system will eventually reward you. And then AI started gutting jobs, housing prices detached from wages forever, and the real purchasing power of your paycheck quietly kept bleeding out. So today you are going to learn the dark logic behind the way elite investors think. You are going to learn why Buffett's public image is not the whole story. You are going to learn how money really moves when panic starts, especially when the Federal Reserve cuts rates or pauses and tells you everything is fine. And you are going to connect it to the world you live in right now, with AI replacing middle-class roles faster than training programs can catch up, with commercial real estate wobbling, with insurers retreating in climate-hit areas, and with retirement systems running on promises they cannot fully pay. And here is where it gets personal, because the biggest trick is not that rich people beat you. The biggest trick is that they made you thank them while you drown. The first uncomfortable truth is simple. If you think someone made money from the market while you watched from the sidelines, you are missing the mechanics. Markets do not create wealth out of thin air. They redistribute risk, timing, and leverage. Buffett taught millions of people that long-term investing is about discipline. But the discipline that elite players use is not the discipline you imagine. It is not romantic patience. It is timing. It is cash management. It is controlling exposure when the rest of the crowd is being herded into the same trade at the same time. Picture a 40-year-old nurse named David. He is burned out, but he follows the script. He contributes to retirement accounts. He buys what he is told is safe. He watches headlines about the stock market reaching new highs while his expenses rise. He does not feel powerful, he feels lucky. He thinks, maybe it is finally working. Then one day his credit card bill jumps again, not because he spent wildly, but because rent increased, groceries increased, and the monthly cost of keeping the lights on is now a second job. He checks his portfolio and sees it is up. He feels relief for about 10 seconds. Then the next 10 seconds are the truth. He realizes his portfolio gains are happening faster than his life costs, but his life costs are still climbing. His purchasing power is not recovering to 2019 levels. Even if a number on a screen goes up, his actual ability to buy things is still shrinking. Real inflation is a tax on patience, and you cannot vote it away. Now imagine the other side of that trade. Someone is using David's confusion. Someone is using the fact that human beings hate uncertainty. Someone is using the fact that when prices rise, everyone assumes it means safety, not danger. This is why the image of Buffett matters so much. He is not just a person, he is a signal. When a legendary value investor starts doing something unusual, it is because the market has started behaving like a machine built to transfer money upward, not wealth outward. And here is where people start lying to themselves. They call it genius, they call it luck, they call it wisdom. But the real mechanism is brutal. When the smart money reduces risk, they often do not reduce it because they love safety. They reduce it because they know the crowd is about to get crushed. So why do the crowd keep laughing at Buffett when he lags the market? Because the market is trained to reward the impatient in the short run. It is trained to reward momentum. It is trained to reward narrative. The crowd in 2000 laughed at value. The crowd in 2007 laughed at caution. Then the Nasdaq collapsed in 2002, the financial system cracked in 2008, and suddenly the people who were laughing were the ones quietly taking losses. But in 2026, you do not just have stocks. You have AI accelerating everything. You have automated trading. You have algorithms that can scan price changes and liquidity gaps in milliseconds. And you have everyday people making decisions based on social media clips that go viral because they sound confident. In other words, the market is faster and more emotional than ever. The old advice still gets repeated, but the new reality is that you can be right about long-term value and still lose money because your timing is wrong and your leverage is too high. And that brings us to the second truth. The market is not just a place where investors trade companies. It is a place where debt and expectations get priced into the future. Elite investors understand something most retail investors are never taught clearly. When credit conditions tighten, everything breaks differently than people expect. When liquidity dries up, the first casualty is not always the company with the most debt. It is the weakest buyer. It is the person who cannot refinance. It is the firm that cannot roll over credit lines. It is the household that cannot absorb another price shock. Look at what has happened to everyday life since 2020. Even when headlines say inflation is cooling, the cost of being a normal person never went back to what it was. Interest rates stayed high enough to punish borrowers. Rent stayed sticky. Insurance costs rose as climate disasters turned rare events into an annual pattern. In the United States, the United Kingdom, Canada, and Australia, housing became a wealth gate, not a lifestyle choice. And while your monthly budget got squeezed, the stock market kept finding ways to go up, not because people became richer, not because wages magically caught up, but because liquidity found a route, because profits were concentrated, because share buybacks reduced the supply of shares, and because the top of the income pyramid was able to borrow and invest in ways the bottom could not. Now bring in commercial real estate. After the pandemic, office occupancy never fully recovered the way people hoped. Some companies shifted permanently to remote or hybrid, so the buildings built around constant foot traffic started leaking value. And when you combine that with higher interest rates and tighter underwriting, you get a slow-motion collapse of refinancing. A major loan does not need to default tomorrow for the system to be in trouble. It only needs to not be refinanced on favorable terms. It only needs to be repriced. It only needs a buyer pool that shrinks. Now connect that to what happened in past crises. In 2002, credit quality was manipulated and reassigned. In 2007, the credit problem became a chain reaction. In 2008, it turned into a global liquidity event. So when Buffett has a massive cash position, you should not interpret it as a quirky personal choice. You should interpret it as a strategic answer to credit risk. Cash is not just waiting. Cash is optionality. Cash is the ability to buy when everyone else is forced to sell. And here is where your anger should rise, not at Buffett personally, but at the education system that told you to clap for the same pattern every decade. They tell you long-term investing is the solution, but they never tell you the other half of the equation. Long-term investing only protects you if you do not get dragged into forced selling first. Forced selling is what kills most retail investors. When the price drops, they panic. When the price drops more, they sell to raise cash for life. They sell at the worst time, not because they understood the business, but because they understood their bank account. Now here is a micro story that matches 2026 reality. Imagine a 29-year-old called Sarah. She works in customer support at a mid-sized tech firm. AI starts automating her tasks. She is not fired immediately, but her workload changes and her department restructures. Her manager says, new opportunities are coming. But the new opportunities are mostly for people who can build workflows or manage automated systems. Sarah tries to learn. She signs up for courses, she watches videos, she thinks she can upskill her way out of a problem that is being solved by machines that do not need salaries. Then inflation hits again, and her rent goes up. She has less flexibility because her emergency fund is not infinite anymore. Her job becomes fragile, her portfolio becomes a lifeline. When markets wobble, she sells a chunk of her investments to cover a gap. She tells herself she will buy back later. But buying back later is usually a trap. Markets recover faster than human beings can emotionally process losses. She buys back higher, she loses twice. Meanwhile, someone else has cash. Someone else has optionality. Someone else sees the same wobble and calls it an opportunity because they are not forced to sell anything. So when Buffett is rumored to be shifting from stock exposure into massive cash, you are supposed to think about optionality. You are supposed to think about survival liquidity. You are supposed to think about what happens when a bank needs to sell assets quickly. And that brings us to the third truth. The most dangerous thing in a market is not the decline, it is the hidden fragility inside the institutions that are supposed to buffer you. The story people remember about the great investors is the part where they get rich. The part they never talk about is how they reduce the chance that the system breaks in their lap. In the past, when credit rating dynamics shifted, markets did not just move down, they moved down violently. Liquidity disappeared, bids vanished. What had a price suddenly could not be sold at anything close to reasonable. In 2002, a credit rating change triggered forced sales. In 2007, the collapse came into view, and everyone realized that safe labels were not safety. They were a narrative attached to a balance sheet. In 2026, the narrative changes, but the mechanics do not. Now it is not just residential mortgages or collateralized debt, it is also commercial real estate refinancing risk. It is also private credit underwriting. It is also insurers trying to recalculate their exposure after climate losses. And in the middle of that, the Federal Reserve plays its role, not as a villain, but as a lever. When the Fed raised rates, it did not just impact the economy. It impacted mortgage payments, it impacted corporate refinancing, and it impacted how much money investors were willing to pay for risk. When the Fed kept policy tighter for longer than people expected, it punished leveraged models. That matters because leverage turns small problems into system-wide panic. So when you hear that the market is going higher anyway, remember what that usually means. It usually means liquidity is still being directed to places that can sustain valuations. It usually means the system is functioning for now. And here is the cliffhanger that you need to sit with. Most people think crises start with dramatic news. In reality, crises start with something boring and structural. Office loans reset. Retail purchasing power declines. Delinquency rises. Refinancing windows close. Insurance rates spike. Then the panic arrives later as the final domino. So let us return to the Buffett idea, because it is not just about him, it is about what his cash position represents in the broader system. When a top investor holds record cash during a period where many stocks appear expensive, it suggests that he is not betting on a smooth continuation. He is positioning for a break in the market's confidence. Now ask yourself a painful question. Why did so many people ignore the signs after 2019? Why did they assume that this time is different for 5 years straight? Because they were trained to believe that markets are like weather. You can check the forecast and you can plan around it. But markets are not weather. Markets are behavior. Markets are incentives. Markets are who can borrow and who must sell. AI didn't change that. It accelerated it. In 2026, AI is eliminating middle-class tasks that used to create stable income. Customer support, entry-level analytics, basic coding, repetitive design, even parts of legal document review are being restructured. You can feel it even if you do not want to admit it, because the help wanted signs shrink while the output keeps increasing. So your job stability is not just a personal issue, it is a market risk factor. When your income becomes fragile, your ability to hold investments through volatility becomes fragile, and when you cannot hold, you become part of the selling pressure. That is how retail gets harvested. Not by a single villain, by a system that converts your stress into their entry price. And now we go to the fourth truth, the one people usually avoid because it ruins the entire fairy tale of investing. Buffett's public story is about building wealth slowly, patiently, thoughtfully. But the dark truth is that the system around him can be built to make patience profitable for the rich and expensive for everyone else. Let us use a simple analogy. Imagine a landlord who wants a profit. He builds houses that are slightly overpriced relative to local wages. In a normal world, some houses do not sell. He would lose. So what does he do in the real world? He does not just wait, he arranges financing. He lends to the buyers. He packages the risk. He structures it so that the buyers can buy now, even if they cannot pay later. At first it works. People move in. Sales look great. Prices keep rising because demand is artificially supported by credit. Then something changes. Maybe interest rates rise. Maybe wages stagnate. Maybe layoffs increase. Maybe remote work reduces demand for office-adjacent retail. Suddenly, people cannot refinance. So what happens to the houses? They get sold quickly, at lower prices. The lender's asset value drops, but the lender may have positioned earlier. The lender can buy back through intermediaries, or the lender can profit through debt structures. Now apply this to the stock market and the asset market you live in. When the Fed signals liquidity will remain, people rush in. When expectations rise, prices rise. When prices rise, companies look stronger than they actually are. Then, when the window closes, forced sellers show up. That is when value investors get their biggest opportunities. But you have to understand who gets the opportunity and who gets the lesson. The rich get optionality. The poor get loss. In 2026, optionality is everything because AI has created a wider gap between skills that machines can replace and skills that machines can augment without fully substituting. The learn to code advice from 2020 now sounds like a joke to anyone who watched how AI can generate code instantly. Some people still succeed, but the path is not as open as the internet promised. Competition increased, output increased. Salaries for entry-level roles faced downward pressure. So if your plan is invest in stocks and trust the long term, ask yourself if your long-term stability is intact. Ask yourself if your cash flow can survive a 2-year drawdown. Ask yourself if your debt can survive higher interest costs. Because if it cannot, then your investment strategy is not investing. It is gambling with borrowed life. Now here is the fifth truth, and it is the darkest, because it connects all of this to what happens after the crash. People think after a crash, the market punishes everyone equally. It does not. After a crash, the market creates buying power for whoever still has money. This is why you should care about how institutions behave when others panic. It is also why Buffett's cash position matters as a clue about the direction of elite strategies. When the system becomes stressed, institutions with liquidity can absorb assets at reduced prices. That absorption changes ownership. That is what the title of this whole conversation is really pointing at. Future assets do not just change in value, they change in hands. And in 2026, this ownership shift is happening alongside wealth concentration that is accelerating. According to Commonwealth studies tracking household balance sheets across the world, the top 1% continues to capture a disproportionate share of growth, while median households see wealth gains evaporate under higher living costs. So while you are counting pennies, someone else is counting balance sheets. And while you are scrolling passive income fantasies, someone else is buying assets with financing costs that a regular household can only dream about. The passive income lie is everywhere now. Creators sell the dream that your money will work while you sleep, but the reality is that most creators make zero. Most people do not build